Aviv with a special report. Yes, it's late Sunday night, but this is important because what we see here is there's a lot of activity because of Fed purchases causing MBS prices to rise. Mortgage rates aren't improving, but the Fed, with good intentions, is unwittingly putting the mortgage and housing industry in some degree of jeopardy. We want to break this down for you. Our friend Steve Leisman from CNBC and I, we've spent over 2 hours breaking this stuff down together. He will be reporting on this, but we wanted to get this out to you and so you could see exactly what is happening. So let's take this step by step and break it down. So here we see a chart of mortgage-backed securities. And you can see throughout the month of January, they'd improved. In February, slowed a little bit, kind of flat. But then something happened, as you'll see here. The S&P 500, the stock market, peaks on February 19th. Now, we started to get more reports of the dangers of the coronavirus coming to the United States, and the stock market starts to decline. As a result, as we normally see happen as stock prices decline, that money begins to find its way into mortgage-backed securities and into the treasury market. So the 10-year treasury is declining, mortgage rates are declining as you see mortgage-backed securities improving. And then we get all the way here to March 9th, 10-year treasury hits that 1% range. And taking a look here, you'll see that we did an alert to lock. First time we did an alert to lock in 2020. We rode this all the way up. Now, mortgage-backed securities did start to decline, but what's very interesting and very unusual is that the stock market started to decline as well. So during this time frame, we see between March 9th and March 12th, mortgage-backed securities dropped a whopping 350 basis points at the same time the stock market was declining, and mortgage rates rose almost 1% in just 4 days. Now, this is important to note because, as mentioned before, when stocks decline, mortgage-backed securities benefit. But stocks were declining so precipitously here that there was a need to raise liquidity. There was margins on people who held stocks, and those margins were called because stock prices were dwindling. Well, a lot of times in those cases, you sell other assets that you have to raise cash, one of them being mortgage bonds. And mortgage bonds and treasuries began selling off. Now, what happened here was also during that period, on the 11th of March, the S&P officially entered a bear market. Here, it was down 19.4%. Well, it definitely went over a 20% decline here, and the stock market was officially in bear market territory. Now, on the 12th in particular, this day, everything sold off to raise cash. We had the S&P fall 260 points in 1 day, and at the same time, the MBS mortgage-backed securities dropped 90. During this 3-day period, the S&P dropped 230 points, while mortgage bonds dropped 350. So a very unusual circumstance here to see a total of 500 points drop in the S&P and mortgage bond prices dropping, interest rates rising. Then here on the 16th, the Fed says, hey, we want to come and help out. And they did. They purchased $8 billion in mortgage-backed securities, and you see that starts right here on the Excel spreadsheet. They purchased $7.6 billion in mortgage-backed securities. Now, meanwhile, the S&P was down 324 points that day. But mortgage-backed securities, they were up 166 basis points that day, but it was a wild day. The swing, 217 basis points in 1 day. That's about 0.25%. I'm sorry, 0.5% in interest rate. 0.25% for every 100 basis points normally. This is over a 0.5% change in mortgage rates intraday. Very, very volatile. Now, the following day, as you can see, it was volatile. There was a 90 basis point range. The Fed bought $4 billion, and prices did not change too much. They lost 22 basis points on the day. The S&P gained 143 basis points, but it was still wild, 97 basis point swing as the Fed bought almost $4 billion. Then you see a big down day in mortgage bonds. So on the 18th, the Fed stepped in and bought $6 billion, but mortgage bonds still dropped 200 basis points, and that caused the Fed to worry. So here on the 18th, you see that big purchase by the Fed. The S&P was down, mortgage bonds were down dramatically, and a big intraday swing. The Fed is saying, hey, we're adding, we're buying, but maybe it's not enough. And then we have this wild day on the 19th, a 320 basis point range intraday. and the MBS prices dove from the open down 180 basis points intraday. The Fed said, we got to do something. And they came in to the rescue with a big purchase of $14 billion. Now that stabilized things. As you can see, the Fed stepped in, they bought, and we get all the way up here. But then once the Fed stopped buying, prices dropped and the Fed began to panic. Now this is on the 19th, as you can see, 322 basis point range. The very next day, on the 20th, the Fed said, we've got to do something because prices, here's the open, prices sank all the way down here below the previous low. The Fed said, my goodness, we better do something. And they came in big and bought an amazing $35 billion in mortgage-backed securities, and they caused mortgage bond prices to rise on the day 180 basis points, but intraday it was 380 basis points. It was incredible, but now mortgage rates to consumers, even with all this buying, failed to improve. Why? Well, there was capacity issues. So even though the Fed was in there purchasing $35 billion, and even though mortgage-backed securities on the day, on the 20th, improved pretty dramatically by 186 basis points, interest rates to consumers did not improve because of capacity constraints. And then we have what happened the past week. And here's where the Fed said they were going to come in and come in heavy, because now the Fed sees that they're doing all this buying and they're seeing that interest rates to the consumer are not improving. So they think it's a wise idea to do more. And here's where we get in trouble. Now you can tell here by where we had started to do rate locks that many people within the mortgage industry were locking in rates. And these were very well-timed rate locks. However, up until this point, mortgage-backed security prices were below pretty much all these rate locks. So that means as far as the hedging goes, their hedges were up. They were improved compared to where the market was. But then in the past week, when the Fed said we're going to go crazy, here's what they did. Look what they purchased. 30 billion, 36 billion, 40 billion, 36 billion, 40 billion. For the week, they purchased $183 billion in mortgage-backed securities. And here we go. They bought 30 billion, mortgage backs gained 70 basis points, no rate improvement to consumers because of capacity. But hedge positions, for the very first time, are now a little bit underwater. The next day, hedges get way underwater as the Fed buys 36 billion. MBS prices gain 99 basis points, but now there's huge hedging losses and margin calls begin to mount. Now you get a bunch of margin calls here, and there's the first round. The next day, the Fed purchased 40 billion, but it didn't do too much to pricing, thankfully. The next day they come in and they buy 36 billion and mortgage bonds gain 140 basis points, more hedging losses and more margin calls. And then Friday, they break out the bazooka again. 41 billion. Mortgage bonds gain 90 basis points. They're buying much more than supply coming to market. They're crowding everybody out and they're driving mortgage bond prices higher, hoping that it results in lowering mortgage rates, but it can't because there's capacity constraints. But they push lenders into dangerous territory now because of margin calls. And this is where we are today, ladies and gentlemen. It is a pretty darn scary situation when you take a look at what the Fed is doing, all with good intentions. But what they have now done is put lenders in that position where their hedges are so upside down that their broker-dealers are calling and asking for money up front before loans close and those positions square. It is this cash flow issue that we're hopeful that the Fed hears and stops buying mortgage-backed securities for a short period of time, let these loans close, let the market settle out, and then they can go back and buy them all they like. But this is the situation we're in now. We hope that this clears it up and helps you understand. Please read the article with how rate locks work that we had done so that you can understand why when mortgage prices go up, when mortgage backs do better, causing rates to drop, that on hedging, it causes it to be upside down because they're shorting mortgage-backed securities. They're losing money when mortgage bonds improve. Take a look at both. I think that when you take a look at this and in conjunction with the article, you will see that this is a very, very tricky situation that could have very negative consequences. Let's please hope that the Fed gets this message and stops purchasing mortgage bonds to make this worse. Thank you.